Good afternoon, and welcome to episode 32 of Great Quarter Guys. I have with me Kevin Hill, and I am, of course, Andrew Cox. How are we today, Kevin?
We're doing great. We're doing
Busy
great.
day, of course. You're back for your second podcast of the day.
I back for the second round. So we'll see how it goes. We're talking about. What are we talking about today, Andrew?
So it's a big discussion. So in general, I wanted to get into durable goods demand, and it's a kind of a piggyback off of the retail data that we've been constantly talking about, which we'll talk about here in a moment. But kind of getting into the fact that the retail demand is coming back pretty quickly, but the durable goods demand is likely going to be several quarters away from recovering. And we're going to focus specifically on the automotive manufacturers. So talk about how bad is 2020 going to be? When can they expect the recovery? What are the implications for the used car market, especially with some of the startups like Carvana that have been involved in that market. We're also going to bring Seth Holm in here in a few minutes to talk about this. He covers consumers. He was with us a couple weeks ago, and he was one of the original hosts of this show. So he's going to be in here for this very in-depth discussion about automotive production. But before we do that, let's get on to our one good piece. We're going to continue talking about this Bank of America credit and debit card spending because it is quite fascinating to watch the day-over-day and weekly changes of this data. So here's my key takeaways from the Bank of America data thus far is we're finally seeing a pickup in travel spending. So if you look at that lodging and the airline spending, that's finally picked up a little bit. Not much. I mean, airline spending is still down probably 90% year over year, but that is a pickup from negative 100 or even plus.
More. I think 106% was the bottom, or 101%.
Yeah, and that's because, of course, they've been refunding as well. But we look at lodging now; it's only down about 60%. This is coming off of down, again, about 100% just a month ago. So things are picking up. People are getting back on the road, and that's also apparent if we look at the gasoline spending. That's increased significantly now, only down about 30%, where it was down 50% just a couple weeks ago. That, of course, is in part because gas prices have gone up a little bit, but I think it's apparent that people are out on the road more. People are driving more. I've seen a lot of my friends personally have been taking beach trips. You see a lot of the popular destinations have been packed lately. So you're seeing people get out and do things, and that continues with the restaurant spending, now only down about 25% year over year. That's improved mightily in the last few weeks. And then the three sectors that have just been outperforming, they continue to outperform. That's furniture, online electronics, and home improvement. And this data goes to the 29th of May. I really think the next iteration of this data, when we get it on Thursday, it's going to be much better than even this. I think generally consumers saw people get out for Memorial Day. They saw the protesters out over the weekend. I think it gives them a little bit more confidence that they can go out and spend money outside of their home. So I really think this data is about to kind of pop here in the next couple weeks. What do you think, Kevin?
Yeah, I think we've definitely bottomed. I think especially for this cycle, we've definitely bottomed. I don't know if I'd characterize I wouldn't maybe go as far as it's going to pop, but I think it's going to get it's going to improve. It's going to improve. I guess by pop, I think
we're going to see total card spending go positive year over year for the first time. We haven't seen that yet. We've gotten close. We were down 3% on the 27th, and that, of course, was around the Memorial Day holiday. So you could have seen some distortions there. But I actually think in this next week, we might see at least one day with total card spending positive year over year.
You do?
I do. I'll make that call. We'll keep up with that.
That should have been one of the long shorts.
It should have been, but I think we got even better ones.
We do, yeah.
So we'll
we
talk
have
about
really
that.
good ones anyway. I would take the short side of that. I think I don't think we're going to see a positive for the month of June, certainly.
All right. So
maybe July 4th, you might see a positive number. So that's my call. I'm interested to see what position Seth would take on that as well.
Yeah, let's bring it in now. Seth, do you think, are you with me or are you with Kevin? Do you think we can see at least one day in this next data from Bank of America that is positive year-over-year total card spending?
Yeah, I was thinking through that as you guys were discussing that. There's been a couple days where it sort of gets down to low single digits year over year, and then it kind of goes back to that negative 10% range. At least that's been the trend over the last 2 weeks or so. I'm going to go with Andrew, and I'm going to say at least one day is going to go positive year over year overall.
In the month of June?
Yeah.
Okay.
Yeah.
Nice. All right, so let's hop right into this discussion, Seth. You, of course, know consumers very well. I'll set the table really here. The first topic, the I guess subtopic I want to jump into here with the auto manufacturers is just how bad 2020 is going to be. We've talked about that retail ex auto data that has continuously gotten better, but there's a reason that they exclude the automobile spending because it can be a big spend. Let's look at May sales that were just reported a couple weeks ago, or now they're down 30% year over year, but that is a big improvement from April. It seems like April was the trough for automobile demand. It actually rose 40% sequentially from April to May. And the sales did differ by the OEM. I mean, the Detroit 3 kind of performed the worst. They had upwards of 35% lower demand. And again, the Korean brands outperformed, only down 17% year over year. That's a continuing trend that we'll get into here, that the Japanese and Korean brands have kind of gained market share. But overall, Seth, demand seems to be recovering faster than production, and that's in part because production has been so difficult with the Mexican automotive plants getting back online. What do you think, Kevin?
Yeah,
Do you think?
Oh, I mean, production's been 0% for quite a while. For what, 2 months? It was at 0%. And as you mentioned, Ford and GM are back online, but you still have the problems with production in Mexico coming back online at the same the same time and the same production levels. What do you think, Seth?
Yeah, I mean, I think it's a recovery. If you look at April, I had to study a lot of this stuff because I don't know the auto space as well. But April, I think, had a SAR of about 8.6 million, which is the worst number. I think they started tracking this data in 1980, so it's the worst number ever in that data series. So it is up. In 8.6 million, we've done 17 million plus units for each of the last 5 years. So, you're still that was down, 50% or more relative to that. And so you are seeing a bounce back right now. What's interesting is I think you had both demand plummet in the early stages of COVID, and then you had production shutdowns, and now you're going to have a big fast ramp in demand. Whether it's year over year positive, I think that's doubtful. But you'll have to scramble to keep up on the production side.
Yeah, it's a good point. I mean, that's kind of what's made this inventory levels all out of sorts. I mean, the CEO of Fiat Chrysler said that he's never seen pickup truck inventories this low. They're now at 650,000 units. Again, just for context, there was 900,000 F-150s sold alone last year. So that's really a small inventory level. And I wanted to talk about some of the demand drivers because I guess they're really being saved right now. At least I think that by low rates, really low rates. I mean, we'll get into a little bit about the financing, about what companies can do to increase demand, but they're going to have to be pushing incentives, and I think they're going to. And I also think there is a demand, at least personally, there's a little bit of demand driver there from other spending that they had planned for this year, whether it be international vacations that are no longer available or vacations period. I do think that there is some for the people that haven't lost their jobs. There is some spending left over there. You agree, Kevin?
No, I agree. There's some demand for spending, switching in out from vacations, things like that. I would say I think the demand will pick up once people return to work. When people start having to drive every day, I think you're going to see some demand picked up. I don't know if it'll go back to pre-COVID levels for quite a while, because I think a lot of people are going to continue working from home. And those that are working from home probably aren't thinking about buying a new car, but maybe I'm just an outlier. I could be, because I have no interest in buying a new car right now.
One tidbit that I kind of found interesting, and it's actually one of our one good pieces, one of the first one good pieces that we did, and that was the very quick recovery of demand for new automobiles in Wuhan, the epicenter of the coronavirus, and they basically stated that a lot of people felt that they weren't safe in public transportation systems, so they went out and started buying personal cars. So I was thinking internationally, that actually makes a lot of sense. That places with really strong public transport, you might actually see a little bit of a benefit here, that they feel the need to get a personal car rather than taking public transport. That's likely not the case in the U.S. because our public transport is quite poor, but it could actually see a little uptick, I think. What do you think about that, Seth?
Yeah, I mean, I'm with Kevin. I think work from home is a negative, in the U.S. at least. Work from home is a negative development for car sales. You've seen 40 million people lose their jobs. I would think, a very small percentage of those of 40 million people are looking to buy a new car right now, especially when it's not clear whether or not these unemployment benefits will be extended past July. I mean, even with generous incentives, I saw some car dealerships are offering 0% financing for 84 months, which is as good as it's a really good deal. But I do think that it'll probably take a couple years to get back to sort of 2019 levels in the U.S. on the auto front.
See, and there's another kind of headwind for the auto manufacturers, and that's the used car market. Right now, you've seen from April to May, you saw used car prices on average fall 12%, and the trade-ins for new cars have been really a pillar of demand for the last 10 years. People have been able to get a solid trade-in for their value on their cars, but people are likely going to go to the dealership and say, I'm not going to take that, and they'll just kind of sit on their car for a few extra years. So that really hurts the auto manufacturers as well.
It brings up the question of bankruptcies, Hertz being number one, and what that does to used car values, which bleeds into trade-in values, which bleeds into new car sales.
Yeah, most certainly. So, Seth, you just touched on it a minute ago. You said that it'll probably, be 2 years before you can expect a recovery. What's your outlook on when we can expect demand, not only really for automobiles, but heavy consumer goods to return?
Yeah, so I think you got to separate that. We're going to get into RVs later. That's certainly a heavy durable good. Demand there is really, really nice and increasing a lot. I think it just depends. And then if you look at things like appliances and furniture, those are doing pretty well, I think. Home Depot and all that kind of stuff doing well right now. Cars are a little bit difficult because other than a house, it's kind of like Americans' biggest purchase, at least at the consumer level. And people tend not to, although the housing market is doing fairly well, I think I haven't followed it closely. But, you really don't want to be buying, I think the average sales price in the U.S. in 2019 was something like $37,000 was the number, Andrew. Making a $37,000 purchase when you either don't have a job or there's some uncertainty around when you will, I think this is going to be one of the harder hit segments of durable goods.
Yeah, I do agree with you, and I'm glad you split up the two. And I'm also glad you brought up the point of the used car or the new car price. It actually increased kind of substantially. I want to say it was like 5%. I can't remember if it was sequentially or year over year, but one of the points that some of the reports that we were reading was that this recovery will likely have higher priced cars. It will likely drag the price higher, and that means higher margin cars as well. You think about this, you've seen it. It's likely that people that are going to be buying cars will be buying more expensive cars because they're not the ones that lost their jobs. You've seen this is visible in the average hourly earnings data. You saw it really jump in April because the people that were losing their jobs were lower income earners to begin with. So that's just one tidbit there. But let's jump into that financing bit a little bit, because we can talk about what companies can be doing to increase demand and what companies should be doing to increase demand, and they're not always the same thing. Seth, you were just talking about your sister looking for a new car, and that kind of gave her this ridiculous rate, even though she's got great credit.
Yeah.
And basically, just my point is that, I think a lot of these companies, when things get tight and they might act, quasi unethically when they're looking forward to this, and they kind of trap people that aren't exactly financially literate into long-term terrible deals. And 5-6 years from now, they're kind of upside down, Kevin.
Yeah, I mean, that's where the profit center is in car dealerships. You have the maintenance division as well as the finance division. So if you can't make money on your gross margin on the car, you wrap it into financing. You get pretty exotic with that financing, and all of a sudden, that's where your profits come from. These 5, 6, 7 year type. You just get very creative with
exotic.
that,
I like that
and
word.
you sell off your loans. Kind of like bundled mortgage-backed securities. Now they have the auto securities as well. So you get into that game. I have a friend back in Oklahoma who has a car lot. It's a buy here, pay here. And it's, I wouldn't call it predatory lending practices, but it's certainly, they're not going after the very wealthy, and he saw a lot of business coming in the early March of people knowing that they're going to get $1,200 stimulus checks, and it's time to upgrade their used car. So.
Hey, at least one thing that I think they actually can do, and they definitely should do, is something that Anthony Smith mentioned to me, is that similar to things they did in 2008, 2009, was give back, look to extend no penalty cancellations, so that people, when they get into a lease and they can come back and bring it in and terminate the lease early, they don't really get penalized heavily for it. To any car manufacturers listening, I know you're not, but I think you should do that. But that's pretty much it. We don't want to spend too much time on predatory financing. But one thing that I think is a really interesting topic that Seth and I have been looking at is the Bank of America analysts, some of the stuff that we were reading, they are expecting and projecting new model releases to be to go up 50% in the next 4 years. So there are a lot of new cars, a lot of new models hitting the market. And I'll start here, Seth, that there's three real ways to make money in an industry, and it's differentiation, cost leadership, or superior quality. And right now the quality of the cars is converging pretty much everywhere except for maybe the ultra luxury and the very budget cars. And then cost leadership has proven kind of unattainable for a lot of the U.S. manufacturers. It's just easier and cheaper to build cars in some of the Asian markets. So differentiation is really all they have left. That's why they're coming out with so many models, isn't it, Seth?
Yeah, I came away mixed on this one. So I think the tone of their overall report was, as car manufacturers release a lot of new models, that helps drive market share, which then in turn helps drive sales and profits and therefore stocks. On the other hand, I was kind of adding up the market share, and it looks like I want to say the big three U.S. guys have about 45% unit share. The Japanese guys have about 33%. The Koreans have about 8%. The Europeans have about 8%. And then there's 7 or 8% other, which would include Tesla and everybody else. So there's this big market share fight. It's kind of a mature industry. You've got the SAR coming down from 17 million last year to 13 million here. I didn't come away as bullish on the prospects of releasing, 65 new models a year. To me, it kind of speaks to how commoditized and mature the industry is. And at some point, I think you kind of risk sort of over inundating the consumer with choice. And, we also talked about offline, so brands, I think, in the last 20 years in the auto space have really slipped, particularly for the big three U.S. car guys. I mean, people used to be a GM guy or a Ford guy. And like I said, I still think they definitely are on pickup trucks or, in the luxury segments. You either drive a Lexus, a BMW, or a Mercedes or what have you. But sort of the small to mid and lower end is just getting hollowed out, where the Koreans are taking market share. And so, the only great brand I think remaining is honestly Tesla. Now, some of the luxury ones have some really, really great brands as well. But I think all the momentum on the brand side, in terms of not having to advertise and having people that just naturally pin up demand to buy your cars, I think Tesla is making some really good strides there. So I do think that you'll have a nice cyclical rebound, just given the fact that car sales are just so depressed in April and May. But I do think that as that initial rebound and tailwind kind of fades naturally, because, you only buy a new car every 5 or 7 years or whatever it is, I do think that there's a risk there to profit margins. And we also saw that, crossover SUVs have been a really hot space. And so now everybody's releasing, 10 versions of their own crossover SUV, which is going to hit both sales and margins for all these guys. So I do think that once the easygoing rebound is over, these guys are going to have to think of sort of new innovative ways to differentiate themselves.
Seth, that kind of begs the question to me. This is something I wanted to pose to you. We talked about it a little bit offline. It's that, Tesla is changing the model for which auto manufacturers may run. And I wanted to question you whether do you think that's possible? They're no longer, they have no plans to release, 10, 12 models a year. They have their 4 models that he has lined up as sexy, the S, the 3, the X, and the Y. And rather than creating new models and coming out with a new one every year, they rather kind of build you a reliable, very simple car that can just run updates on the software that it runs on. So, I mean, do you think that this is something that the other car manufacturers may go after, now that cars are becoming more computerized every year? Or do you think that they're going to continue down this how long do you think they're going to continue down this road of just releasing model after model after model?
Yeah, some thoughts there. I think that, and again, I'm not an expert in this space. I do think that's a more attractive model, sort of that Tesla is developing in terms of releasing a car and then just doing software updates. But I do think it's a dangerous. So if you think about how traditional legacy automakers make their profits, it is releasing those cars every year. So
Hmm.
they have more. There's more of a transitional risk of going to that new Tesla model for them because there's unknown and you might be cannibalizing some of your own sales and profits. So I don't think that transition will be as easy for them. And then on the engineering side, I think Tesla is a little bit ahead, and I'm going to sound like too much of a Tesla bull. I am a Tesla bull. Um, uh, you know, I do think that I don't see, at least given the fact that these guys are still selling 95% or more of the units in the U.S. And this has been their historical bread and butter for how they make money. And so much of their R&D and their capex budget is focused on new models and upgrades to existing models. I do think that there's sort of a lot of built-in culture and history there that's going to be difficult to change.
You both talk about Tesla and pin-up demand, not having to pay for sales and marketing. Do they capture that on the bottom line? Those savings on those expenses. Is that something that they do as of now?
Seth, you want to take that one?
Is that me or you, Andrew?
I think you
No.
follow him a bit closer.
So I think Tesla's gross margin was 25% in this latest quarter, and they're not having issues on the demand side, and the deliveries and all that are improving. There's a little bit of a cannibalization from the Model 3 is cheaper than the Model S and all that, so there's a negative mix shift effect going on there. Although when the Model Y comes out, that may head in the opposite direction and help them again. But no, I mean, their gross margin is improving, so their potential profitability is improving. But no, they have not. I think they were profitable in Q1. They've got $8 billion in cash on their balance sheet, and they've actually generated some free cash flow over the last year. And then they raised $2 billion more in an equity offering back in February. So long answer, I think the balance sheet side of Tesla is getting better, but I know Kevin's jabbing us with that comment. Yeah, no big payoff in terms of ROI thus far, without having to do all the advertising.
Yeah, you want, is that your puppy going wild in the background there, Seth?
Yeah. That's my golden retriever there in the background.
Yeah, I got you. I got a yappy golden retriever as well. So before we move on to our long shorts, this will probably be the last subtopic we can get into. You did mention it earlier, how we need to kind of differentiate between heavy consumer goods and the car demand, because one of those reasons is because the appliances have been so hot and the RV market has been so hot. And the RV market isn't something that I follow so closely, but I know both of you do. So Seth, you want to take it from the top and just kind of tell us why the RV market is so hot right now?
Sure, I'm unmuting now. I think he's stopping barking. It's usually the FedEx guy. Let's see. So the RV market sets up really well in terms of COVID. So they've got a lot of sort of perfect tailwinds right now. So the RV market, people are itching to get out and travel, right? And so you've got these low gas prices. An RV allows you to travel, but you don't have to go to a dirty hotel room or get on a dirty plane. And you can kind of get out and see the country, and you have your own kitchen and your own bathroom and all this kind of stuff. And you can social distance and you can be with your family. And it's also cheap, right? And then you've got cheap and plentiful financing available, a lot of other stuff. I mean, the RV market has seen a big positive change in demographics over the last few years. RVs really used to sort of be for just sort of old Caucasian retirees, and that's changing big time. And so they're seeing buyers from anywhere from 20 to 80 years old, of all different races and everything else. And so there's also been a big mix shift in the RV market to towables. Like if you think about a Windstream, 17, I think it's 17 feet towable. I heard Marcus Lemonis, who's the CEO of Camping World, in an interview recently on CNBC, and he talked about how, if you're a millennial now, you can tow a Windstream towable behind your Toyota Prius, and he can get you into it with no money down for $100 a month. And so you don't need this big F-150 pickup truck to pull it along, and then you don't need some huge storage space at your house to store the traditional RV. If you think about traditional RV is probably, I don't know the difference, but it's like as long as a tractor trailer. So, so you've got all these things sort of coming together. And then you've got people are too afraid to, get on a cruise or get on a plane or go out of the country and go to Europe and fly, do whatever. And so all that's kind of coming together nicely for these guys.
I'll echo what Seth said. We both own some RV stock in Camping World, and it's been very good to both of us, I believe. It's a nice big gain. So as long as the RV market is humming along, I'm happy.
All right. Well, that's been a great conversation. I'm sure we could go for a full hour on that. Seth, stick around for long shorts here. We're going to move right into them. So I know we've been talking about Nikola a lot, guys. I don't get on to me here. There's a lot to talk about there. Their stock was up 70% yesterday, so there's just a lot to unpack. The market is very excited for another electric vehicle focused company on the market besides Tesla. So I want to pose a question to you, or something that Trevor Milton said on Twitter today. He says that it is his aim to dethrone the F-Series, the F-150 series. This has, of course, been the highest-selling car in America and by far the best-selling pickup for, many years. Again, I said a few minutes ago that they sold 900,000 F-150s in 2019, and that was actually down from 2018. So they sell a whole lot of F-150s. So, Seth, I'll pose it to you first. Do you think that Nikola is capable of dethroning the F-150, or do you think they're even capable of really getting a solid piece of that market share in the F-150 market? There's both.
But we have to put a time limit on this. How many years?
Okay, yeah.
Right?
All right. You give me 20 seconds. Is that right?
You get as long as you want.
Okay. So first things first, I'm a huge Trevor Milton fan. I think what he's done is some really good stuff. The stock performance has been nothing short of incredible. I like his vision, and he's got a little bluster like Elon Musk to him.
Yeah, he does.
I think they have no chance of dethroning the F-150. But if they can sell even, through their pre-orders, one thing I think he's done well is if you want to take market share from the F-150, you got to make the truck look good to a truck buyer, unlike the Cybertruck. But I do think he'll get some traction, but it'll be tiny.
It's all about what amount of time we're going to put on this. Could he eventually someday? Yes, but you need hydrogen fuel stations.
Oh, they're actually a mix. So you got hydrogen and they go EV batteries. They're a hybrid truck.
Then you need EV battery stations.
Yeah,
more than
what we have now.
Than what you have now. So I think once that's done, I'm going to go short.
Yeah,
it's just such a tall task. But just if you put all your resources to do that, you're going to sell a lot of Nikola trucks.
Yeah, I want to echo a couple points. I'm with you, Seth. I think the truck is gorgeous, and I think it will attract some of those F-150 buyers that are looking for a traditional truck that's kind of got this upgraded new tech feel. I think they will steal some market share there. I don't think there's any way on this green earth that they could ever dethrone the F-150. I think they're going to continue to sell a lot of trucks, and there's plans for Ford. They're rolling out an F-150 here in the next couple years. So they're going to be fighting tooth and nail here. So I don't think I'm short on the idea that they can dethrone, but I am long. I'm long Nikola. I think they're a really strong company, and I love Trevor Milton as well.
And I would say it's a beautiful truck.
It's a
beautiful truck. I want to see on the road.
It's a gorgeous truck. All right, the last one is a little sports fun for you, Seth. We've seen that the NBA is going to restart on July 31st, I believe it is. Some of the soccer clubs have already got back online. The NFL is now on pace to get online here in the fall. But I'm asking with you, do you think the MLB gets playing this year? There seems to be a lot of contract negotiations there. Do you think we see any MLB games in 2020, Seth?
No idea. I'm not a baseball fan. I'm excited about golf starting this Sunday, and as long as we have college football, I'll be happy. So I'm gonna go long, just because I've heard Andrew Cuomo talk about how the Yankees can be able to play. So I'll go long.
Okay.
I'm going to go short because of the players' union. Though they'll never accept anything less than 100% salary. They're so far apart. They should do it, but the players are going to push back, and no baseball.
Yeah, sadly, I agree. Baseball is my summer pastime. I don't think we're going to get any baseball this summer. Again, I think their players' union is too strong. I think the players are too stubborn to take, or not too stubborn. They're rightfully so deserve to get 100% prorated salary, and I don't think the league is ever going to do that. So I think that they will have no baseball in 2020, which absolutely sucks. But I do hope we have college football. I'm with you, Seth. Seth, thanks for joining us today, my man. I hope you have a great rest of your week, and we'll talk soon.
Cool. Thanks, guys. See you later.
You're welcome, man. All right, guys. Thank you guys for tuning in. This has been episode 32. We're on a 6-day, 23.5-hour break. See you next time.